Welcome to Critical Minerals for our Energy Future Tour from Mary Hemmingsen based in North America and co-collaborator Andy Calitz based in the UK. Critical minerals are the hidden backbone of clean energy, currently irreplaceable in powering our global energy transition, embedded in driving performance in EVs, wind turbines, solar panels, grids, and advanced clean technologies. The availability of critical minerals, specifically copper, lithium, nickel, cobalt, graphite, bauxite, aluminum, and uranium, and rare earth elements to be covered in our February Part 2 session, underpin the reliability of our energy infrastructure. Yet today, extraction and processing are concentrated in a handful of regions, including Australasia, China, Kazakhstan and Russia, Africa and the DRC, Namibia and Guinea, South America and Chile and Peru, and North America in the US and Canada. While commodities have been driven by cycles, a new level of electrification demand growth and concentration in processing is currently creating strategic vulnerabilities in global supply chains, heightened in a world of growing trade and geopolitical tensions. This reality raises urgent questions. Where are these minerals sourced and who controls them? What environmental and social costs accompany extraction and processing? How resilient are current supply chains and against geopolitical shocks? What policies and investments are shaping future access and security, appreciating resource access lag? And what technologies could reduce dependency or enable recycling? These questions and answers define the direction of travel for energy security and climate goals. So today, we will survey the landscape and journey to the front lines, touring major mining and processing sites to see and understand the associated realities shaping our energy future. In doing so, we seek to build insight into the players, positions, and pressures driving our global energy transition to better engage and influence needed actions. Because without a clear view of the landscape, policy and investment decisions risk being blind to critical constraints and opportunities. The stakes are high. Energy security, economic competitiveness, and climate commitments all hinge on these minerals. So join us in mapping the vulnerabilities and seeing the shape of strategies that secure our energy future for the next hour. Let's mine the periodic table to profile our list of critical minerals. They cluster in 3 horizontal bands along with uranium in a 4th and include on the left lithium, manganese, cobalt, and nickel as key transition alkali metals for battery materials, cycling as ions in compound form, not as pure elementals. Copper and aluminum further right appear as pure metals, enabling connectivity through metallic bonding and electron mobility for electricity infrastructure and components. We've included 2 others, carbon in the top right in the form of flake graphite and uranium on the bottom left, all included for essentialness to our energy future. And as an overall statement, criticality is not about rarity, it's about mineral essentialness for current and future energy systems whose supply is constrained, as we shall see, by geographic concentration, processing bottlenecks, limited substitutes, long development timeframes, and geopolitical or environmental issues. And note, our critical minerals list largely aligns with definitions from others, including IRENA, IEA, USGS, and the EU Critical Raw Material Framework, noting we're excluding manganese, which we classify as moderately critical. Let's start our critical mineral tour with copper, which wires our electrification boom and increasingly requires significant tons of increased supply. Copper is embedded everywhere in electricity flows, usually as wiring, busbars, transformers, connectors, and cooling elements, in conducting power, connecting components, and in removing heat in EV grids, charging stations, renewables, buildings, and data centers. Copper features in the headlines given its criticality of low supply growth and long permitting timeframes amid soaring demand and current concentration and related activities to stimulate new sources. Here, we see structural deficits emerging as electrification demand from EVs, the grid, renewables, and data centers continues to outrun new mine supply. Near-term, stoppages at major operations have been tightening inventories and adding to volatility. Published 2025 rankings reshuffle the biggest mines, highlighting Chile's lagging output and the DRC's growing share, and underscoring operational fragility in one region and rising dominance in the other. On copper prices, the London Metal Exchange price hit records early in January with forecasts split. Some expect a pullback as supply responds, while others anticipate persistent tightness given long project lead times. Meanwhile, soaring demand is fueling takeovers and investment is pivoting to brownfield expansions and faster permitting to unlock new tons. Andy, let's see these headlines on the ground in copper players, positions, and places.
Copper production has risen from 16 million tons in 2000 to 26 million tons today, reflecting the steady long-term growth driven by global electrification. For each of our critical minerals today, we're going to be looking at reserves, production, exports, imports, smelting and processing and consumption. And starting with the players and positions in terms of supply and demand, we can clearly see that Chile, Peru, the Democratic Republic of the Congo, Australia and Mexico are dominating reserves, production and the exports of copper. We can see China's leverage, and despite being small in reserves and modest in mining, it dominates imports, smelting and consumption, so it's a system choke point. And we can see that Japan, South Korea, Germany and the United States are major importers in terms of also smelting and consumption. Let's visit 4 significant places in copper in the world: Escondida in Chile, Cerro Verde in Peru, Kamoa-Kakula in the Democratic Republic of the Congo, and Guixi in China. Chile is the world's largest copper producer, supplying about 1/4 of global mined output. Major mines include Escondida, Collahuasi, El Tiente, Chicacamata, and Los Pelambres. Production in Chile faces declining ore grades, water scarcity, aging infrastructure, and rising costs. And so today, investment focuses on brownfield expansions, desalination, automation, and sustaining long-term export revenues. Escondida, that we see below us, is the world's largest copper mine operated by BHP. It supplies about 3.5% of global demand. The open pit ore feeds large concentrators producing copper concentrate for export. In the Atacama Desert, operations rely on energy-intensive desalination and long pipelines for processed water, and sustaining more than 1 million tons of production per year requires continual efficiency and capital. Peru is the world's second largest copper producer, supplying 12% of global output. Key mines include Cerro Verde, Las Bambas, Antamina, Southern Copper Operations in Quellaveco, and growth is constrained by community protests, permitting delays, transport disruptions, and gradual ore grade decline. Despite this, Peru's long-term potential remains very strong, with major Andean resources supporting continued brownfield investment and selective new developments. Cerro Verde, that we see below us, is a large open-pit mine near Arequipa. It's been operating since 1975, operated by Freeport-McMoRan. It supplies about 2% of global copper. 3 concentrators produce concentrate and cathodes for export, and desalinated water supports the operations, produces 450 kilotons per year, but this requires ongoing efficiency and capital. The Democratic Republic of Congo is Africa's largest copper producer, contributing about 9% of global supply and growing very fast. Major mines include Kamoa-Kakula, Tenke Fungurume, Mutanda, and Komoto. And growth is driven by high-grade deposits and strong Chinese-backed investment in mining and processing. Key risks include political uncertainty, infrastructure constraints, royalties, and ESG scrutiny over practices and governance. Kamoa-Kakula, that we see below us, is the Central African Copperbelt's significant mine, operated by Ivanhoe Mines. It's among the world's highest grade copper deposits, 5% copper. Production exceeds 400,000 tons of copper per year in the form of concentrate from an integrated mining and processing complex. An expansion aims to raise output materially and add smelting capacity, strengthening its competitiveness. Next, we travel to China to see copper smelting. China dominates global copper smelting, importing over 60% of world concentrates and processing roughly half of global supply. Capacity expanded rapidly, supported by infrastructure and scale and industrial policy. Smelter clusters near ports, power and sulfuric acid markets, and environmental standards have been tightened, pushing closure of inefficient plants and consolidation into much larger sites. And this smelting dominance gives China leverage over global concentrate markets and treatment charges. Quishi copper that we see below us is the world's largest copper smelting complex operated by Jiangxi Copper. It integrates smelting, refining, and sulfuric acid production. It produces both domestic and imported concentrates at large continuous scale. Modern smelting technology improves efficiency, metal recovery, and emissions control, and Guishi anchors a major downstream copper and manufacturing cluster in Jiangxi. Supplies will come from Reko Dik in Pakistan, Oyu Tolgoi in Mongolia, Resolution Copper in the United States, and Waifi Golpu in Papua New Guinea. And so Mary's copper's criticality presents three constraints and risks to the energy transition. Copper mining faces declining grades, water scarcity, and permitting delays. Copper smelting and refining are geographically concentrating, and copper demand will rise from grids, electric vehicles, and renewables.
Moving from copper, let's explore lithium, which enables electrochemical reactions that store and release energy for lithium-ion cells, cathodes, electrodes, and battery packs. Given this role, lithium's criticality is featured in the headlines related to supply chain vulnerabilities and activities reshaping the market. Here, the current lithium price slump is driving consolidation, partnerships, and delayed expansions, even as long-term EV and energy storage demand remains strong. Headline spotlight Greenbushes, Australia, the world's largest hard rock lithium mine, supplying 20% of global output and viewed as a strategic asset for OEM, EV, and battery storage supply chains. While Australia keeps near-term markets well supplied, conversion capacity remains China-centric, reinforcing refining dependency risks. For South American supply, water use and environmental scrutiny intensify for brine operations, prompting Chile and the Andean nations to pursue state partnerships and resource nationalism. Also on the supply side, lithium recycling remains nascent, but could matter post-2030, while the move to LFP for cost and safety and advancing solid-state technologies are expected to reshape future lithium demand and hydroxide versus carbonate needs. So Andy, let's see the players and places shaping the lithium industry markets.
Since 2000, lithium demand has surged from 20,000 tons to more than 230,000 tons, with a sharp inflection after the 2015 as electric vehicles scaled. In terms of players and positions, it is very clear that Chile, Australia, and Argentina dominate mining and exports. We see the Bolivian paradox, the largest reserves globally but no material production or exports. We see that China's system power, it's not the biggest miner, but China dominates imports, processing, and consumption, and controls conversion to lithium chemicals. And we see Western vulnerability with the US, Japan, Korea, and Germany, high in consumption, low in reserves. So overall, we see an extreme upstream, downstream separation in lithium. Maybe we're going to tour Salar de Atacama in Chile, Salar de Hombre Muerto in Argentina, Greenbushes in Australia, and the cattle battery plant in Ningde in China. Chile is a top global lithium supplier with over 20% market share, anchored by high-quality brine resources. Policy is evolving, stronger state oversight, royalties, quotas, and permitting shape the pace of expansion in the country. Strategy focus on growing output while tightening water governance and community legitimacy. Salar de Atacama in the Atacama Desert is brine pumped, solar evaporated, and then chemically refined. And that water balance drives ESG and the politics of lithium. This world-class brine salar in the northern Chile is amongst the lowest cost lithium resources globally. It is operated by SQM and Albemarle under state concessions, exporting lithium carbonate and increasingly hydroxide into global battery markets. Argentina is also a top global lithium producer with over 6% share, anchored in the Andean lithium triangle brines. Provinces control the resources, and policies generally favor investment and rapid project development. Output is spread across multiple salars, reducing single asset dependence compared with Chile. And the growth is driven by brines and emerging direct lithium extraction but faces currency, infrastructure, and ESG constraints. Salar de Hombre Muerto that we see below us is Argentina's most established lithium brine district. Very long-running operations that have proven brine chemistry, infrastructure, and scalable production. It primarily produces lithium carbonate with downstream conversion supporting battery markets, and water balance, community relations, and the sequencing of expansion shape its long-term growth potential. Australia is the world's largest lithium producer, supplying over 50% of mined lithium from hard rock spodumene. Australia's strengths include reliable mining, export logistics, and growing domestic refining capacity. Output is concentrated in Western Australia, where open pit projects can scale very quickly. Key risks are price cycles, permitting constraints, and downstream competitiveness versus China's refineries. Greenbushes is the world's largest hard rock lithium mine, producing high-grade spodumene for global battery supply chains. The concentrate feeds China and emerging Australian refineries, while expansion upgrades pits and the processing facilities. The site also highlights lithium's environmental footprint. Growth is constrained by community expectations, water management, and its tailing capacity. China leads lithium battery manufacturing by scale and dense supply ecosystems across materials, cells, packs, and equipment. The bottleneck is shifting from sheer capacity to quality, cost, safety, and traceability, but also carbon footprint. The country has clustered supply chains of cathodes, of anodes, electrolyte separators, and formation and testing, enabling speed and rapid learning. Calitz is the world's largest cell maker, supplying many automakers with both mass market and premium chemistries for batteries. Its advantage is industrial execution, high yields, rapid scale-up, and tight integration with materials and equipment partners, and its strategy focuses on global factories, cost reduction, and long-term contracts. The Calitz plant that we see below us in Ningde is Calitz's anchor campus, the headquarters, plus a large-scale cell production, testing, logistic, and suppliers, and multiple long factory halls operate as a coordinated manufacturing cluster, supporting grid power and port road access. Inside the factory, automated robotic systems stack the cells, move the components, and convey products through precision assembly and testing lines. Next lithium supplies will come from Thacker Pass in the United States, Hemmingsen in Argentina, Kathleen Valley in Australia, Grota de Cirillo in Brazil, and Sal de Vida in Argentina. So, Mary, lithium's criticality arises from three constraints. Processing capacity lags projected demand growth, supply chains remain concentrated geographically, and the markets are volatile with rapid capacity shifts amplifying price cycles and investment uncertainty.
Next, we visit nickel, critical to enable high-energy cathodes that boost batteries' ability to store more power in the same space, which means longer driving range for EVs and better performance for devices. In the headlines is a nickel snapshot highlighting critical supply and price dynamics and processing concerns. More specifically, Indonesia has cemented its ecosystem dominance in laterite in nickel-rich ore, or through high-pressure acid leaching to make nickel for batteries. This footprint of laterite processing is in turn raising ESG concerns in processing emissions and tailing risk. The headlines also speak to the economics of battery-grade nickel under pressure as supply outpaces EV cathode demand for nickel-based batteries amid emerging battery chemistry preferences. Subdued prices have pushed miners towards cost control and downstream integration over new greenfields, while in January, Indonesia's supply controls underscored concentration risk and drove a 10% jump in the LEM price. Let's visit the nickel landscape.
Global nickel output has expanded from 1.1 to 2.5 million tons since 2000, with recent growth increasingly tied to batteries alongside stainless steel. And Mary, as you noted in the headlines, in terms of players and positions, Indonesia is structurally dominant, large reserves, production and processing growth, policy-driven shift from exporter to domestic refining powerhouse. We see significant reserves in production and exports from the Philippines, Russia, Australia, and Brazil. We clearly see China's midstream control, modest reserves in mining, dominates smelting, refining, consumption, and has the ability to set prices and specifications. And then we see imports and processing in Japan and South Korea and the United States. Nickel has a bifurcated market. Stainless steel anchors the demand. Battery demand is volatile as nickel and lithium battle it out for battery technology. Let's tour to Weda Bay in Indonesia, Morowali also in Indonesia, Norilsk in Russia, Jinshuan in China, and Outokumpu in Finland. As Mary mentioned in the headlines, Indonesia is the world's largest nickel producer, supplying 45% of mined nickel for stainless steel and increasingly for batteries. Its strengths include huge laterite reserves and rapid investment in battery-grade processing, but its key risks are oversupply, policy shifts, and changing battery chemistry. The major players include Tsingshan, Vale Indonesia, and Antam. Below us we see Weda Bay. It's a large laterite nickel mine on the Halmahera Island owned by Tsingshan and Eramet. The open pit ore feeds an integrated industrial park with processing power, with port logistics and export bans have accelerated domestic refining and very fast capacity growth. Environmental scrutiny is high due to rainforest impacts and tailings. Indonesia not only leads nickel output, it's also a major processing hub with significant high-pressure acid leaching capacity, producing mixed hydroxide precipitate for EV cathodes. Nickel pig iron and ferronickel smelters support stainless exports from large Sulawesi industrial parks, and the key hubs are Morowali, Weda Bay, Obi Island, and Pomala, expanding quite rapidly. Risks include coal-powered processing, raising emissions and ESG concerns, and policy pushes domestic refinery, so raw ore exports have been banned. This continues to reshape its trade flows. Below us we see Morowali. It's the world's largest nickel processing hub, integrating ore handling, power generation, smelting, and deep water logistics, and it produces nickel pig iron, matte, and battery intermediaries for stainless steel and EV supply chains. Russia is a major nickel producer, producing around 10% of global supply, anchored by Nornickel. And it supplies high purity class 1 nickel used in batteries and also supports stainless steel markets. Sanctions, Arctic logistics, and environmental legacy issues add geopolitical and ESG risks related to Russia influencing trade flows and buyers' sourcing strategies. Below us we see the Norilsk Talnak complex in Arctic Siberia. It mines nickel, copper, and platinum group metals all year round. It's owned and operated by Nornickel. It's one of the world's richest deposits. Mining is predominantly underground, with processing at local concentrators and smelting into matte. And the product is shipped via the Rudinka port along the Yenisei route, with sanctions constantly reshaping destinations. China dominates global nickel processing with over 65% share despite limited domestic nickel ore. Its advantages come from importing concentrates, matte and laterite derived intermediates, and then converting them into refined nickel products and nickel sulfate for battery cathodes. Processing scale, technology, and industrial clustering underpin stainless and battery supply chains. Environmental standards, energy costs, and policy direction increasingly shape where and how new capacity in China is being built. The Jinshuan smelting and refining complex is China's largest integrated nickel copper smelting and refining hub. It converts sulfide feeds into matte and refined nickel, plus copper and cobalt as byproducts. The complex includes smelting, power supply, slag handling, and tailings management, making it a strategic anchor for China's nickel supply chain. Nickel is also recovered when stainless steel scrap is smelted in electric arc furnaces and argon oxygen decarbonization plants across Finland, Spain, Italy and the United States, Japan, South Korea, China and India. And this route keeps nickel in the stainless loop, realloyed into new products, reducing the demand for primary nickel mining and smoothing supply risks. And the scale depends on scrap availability, stainless production cycles, and the ability to sort high nickel scrap efficiently. Outokumpu that we see below us is one such facility. It's in Tornio in Finland, and it's Europe's largest stainless steel complex, smelting nickel-bearing scrap in electric arc furnaces and refining it in argon oxygen decarbonization units. And it's one of the world's cleanest examples of closed-loop industrial nickel recycling into stainless steel at scale. To keep up with the demand, next nickel supplies will come from Ramu Nikku in Papua New Guinea, Dumont in Canada, Turnagain also in Canada, and Weda Bay in Legend in Indonesia. My takeaways on nickel's criticality for the energy transition is that nickel supply is concentrated and constrained by costly, complex and environmentally sensitive processing routes, that nickel refining is geopolitically concentrated, particularly in Indonesia and China, and that nickel processing relies very heavily on coal-powered tailings and high-pressure acid leaching waste, threatening environmental acceptance and financing.
We now visit cobalt, a companion of nickel that stabilizes high nickel batteries. We look to recent headlines to characterize the cobalt landscape, where the DRC's renewed cobalt export quotas with tougher government approvals and compliance have tightened supply, prompting a price rebound. These quota allocations favor China molybdenum and Glencore with the largest shares, while stricter traceability and royalty prepayment now act as gatekeepers for exports. And despite shifts in battery chemistries reducing cobalt intensity, supply remains policy fragile, with geopolitical and regulatory risk keeping supply security a top concern and reinforcing cobalt's criticality. So Andy, let's visit the cobalt landscape on the ground.
Cobalt demand has increased from 30,000 tons to 165,000 tons since 2000, showing how battery cathodes have reshaped a previous niche market. And here today we see the strength of the Democratic Republic of the Congo, followed by Australia and Indonesia in the upstream in terms of reserves, production and export. We see that China dominates the downstream, 70% of imports, refining and consumption. And we see how Finland, Belgium, Japan and Korea punch well above their weight in refining. So let's go see Matunda and metal coal in the Democratic Republic of the Congo, Murun in Australia and Huaiyou in China. The DRC dominates cobalt supply through 70% of supply from Matunda, Tenke Fungurume, Kisanfu, Kamoto and metal coal among the big suppliers. Cobalt is produced mainly as a copper byproduct from large copper belt mines, and as Mary noted, CMOC and Glencore operate much of the output, while China refines most of the volumes. High-grade ores drive growth, but policy, royalties and export rules create volatility for producers. ESG risks persist around artisanal mining, traceability, communities, environmental scrutiny. And there's also a push to secure DRC cobalt offtake through equity participation and aligned ownership. Mutanda, that we see here in Lualaba, has been the world's largest cobalt producing mine. It's operated by Glencore. Cobalt is produced as copper byproduct at peak Mutanda, supplied over a quarter of global cobalt. Output is highly sensitive to prices, to royalties, and various DRC regulatory decisions, but it remains central to battery supply chains and world ESG scrutiny. In the DRC and Zambia, tailings are reprocessed for cobalt, for cheap feed, less mining, and requiring lower footprint. Elsewhere in the world, also smaller cobalt tailings projects in Canada, Australia, and Finland recover metals whilst reducing legacy cleanup liabilities. Below us we see the metal coal tailings reclamation plant near Kolwezi. It is owned by the Eurasian Resource Group. It's a hydrometallurgical facility that reprocesses historic tailings rather than mining new ore. And it produces cobalt hydroxide and copper cathode for exports. And the feedstock is sourced from multiple legacy sites across the Katanga copper belt, making it strategically important for low-risk cobalt supply. Australia contributes 4% of global cobalt supply, mainly as a byproduct from nickel and copper operations. These volumes are modest, but politically and governance-wise the risk is low, which appeals to battery makers seeking diversification from the DRC. Future Australian growth depends on nickel project economics, refining capacity for cobalt products, and ESG-driven demand for traceable supply chains. Below us we see Murrin, a major nickel cobalt laterite operation in Western Australia, operated by Minara Resources, owned by Glencore, uses high pressure acid leach, as we can see, to produce nickel and cobalt products on site, and its output feeds both battery and stainless supply chains. It's a fully integrated high pressure acid leaching facility combining acid supply, power, pressure circuits and hydrometallurgy at industrial scale. Next we travel to China, because China refines most of the world's cobalt into battery chemicals, converting imported intermediaries into cobalt sulfate and cathode materials. The choke point is chemical processing capability and capacity, dissolving, purifying, crystallizing and qualifying battery-grade cobalt rather than ore availability. And the risks sit in concentration and regulation, from environmental compliance, energy and water intensity, and potential export controls that can tighten global supply very quickly. Below us we see Huayou Cobalt. It is the leading Chinese cobalt refiner and battery materials producer, converting cobalt feedstocks into battery-grade chemicals and its precursors, and its advantages: overall industrial integration, upstream sourcing linked to large-scale refining, and material plants supplying cell makers at industrial volumes. And that scale makes Huayou strategically important, while also exposing it to ESG scrutiny, traceability demands, and policy shifts affecting cobalt trade and processing. Next, cobalt supplies will come from Tenke Kisanfu expansions in the DRC, Matoshi tailings also in the DRC, Huayou refining in China, Huayou Ligand in Indonesia, and the Kwinana refinery in Australia. Projects that will lift cobalt hydroxide and sulfate output, adding processing capacity and diversifying supply chains. Cobalt's criticality is reflected in supply, which is highly concentrated in the DRC, processing, which is dominated by China, and demand, for which there is long-term uncertainty as battery chemistries seek to reduce or eliminate cobalt use.
Let's now explore graphite, formed from carbon when organic material is transformed by heat and pressure deep underground. Large crystal flake graphite is the backbone of the battery anode because it holds and releases lithium ions during charging and discharging, making it essential for storing energy in most lithium-ion batteries. In the headlines, graphite's criticality reflects a persistent processing bottleneck and China's lead in anode production, even as Mozambique's Balama restarts and posts full quarter output. Policy efforts continue to push non-China anode diversification and downstream processing investment. And upstream, Madagascar projects remain important but face financing and operational challenges, while new entrants in Brazil and Tanzania add niche large flake capacity, though at a limited scale. Andy, let's explore the graphite players and landscape on the ground.
In graphite, we see demand rising from 0.7 million tons to 1.7 million tons today, and graphite production tracks the rise of lithium-ion batteries as its dominant end use. Turning to production and demand and processing, China clearly dominates mining and is a real choke point in terms of purification, spheronization, and coating of anodes. We can clearly see that Mozambique, Madagascar, Brazil, and India are major upstream exporters of natural flake, and that Japan, Korea, Germany, and the US are downstream importers with growing non-China processing ambitions. On our tour, we're going to visit Heilongjiang province in China, Balama in Mozambique, Lindi Jumbo in Tanzania, and Molo on Madagascar. China dominates graphite mining, processing, and downstream anode materials for batteries globally. Processing, purification, and shaping capacity matter more than raw ore availability. Environmental regulation in China is tightening, consolidating production into fewer, larger industrial clusters in the country. Graphite remains strategically critical for batteries, for refractories, and advanced industrial materials. Below us, we see the Heilongjiang graphite cluster. Heilongjiang hosts a dense graphite cluster integrating open pit mines, concentrators, tailing areas, and downstream processing. The short haul distances reduce costs between mining, flotation, and the purification stages. Multiple operators benefit from shared infrastructure, power, water management, and skilled labor pools, and it demonstrates China's advantage: industrial scale graphite ecosystems, not isolated mines. From China, we move south to Mozambique, that contributes about 10% of global supply and a growing role in graphite diversification. And here we see Balama, which we also heard in the headlines. An Australia-based Syrah operates one of the world's largest graphite mines. Its flake is open pit ore mined, crushed, floated into natural graphite concentrate on site. That concentrate is dried, bagged, and trucked to port for export, mainly to Asia. It produces multiple flake sizes that targets battery anodes in the industrial markets. And its ramp up in production has been quite sensitive to prices, to power supply, security, and logistics risks in the country. Tanzania hosts some of Africa's highest grade natural graphite, attracting international developers and battery supply interest. The potential is very strong, but project delivery depends on permitting stability, infrastructure readiness, and securing downstream processing or offtake partnerships that can qualify graphite for battery markets. Below us, we see the Lindi Jumbo graphite mine. Is among the world's highest grade graphite deposits, supporting low-cost open-pit mining. Processing is relatively simple, crushing and flotation to produce concentrate. Its coastal location near Mtwara shortens logistics to port and export markets, and its development timelines are shaped by financing conditions and graphite price cycles. Madagascar contributes about 8% of global flake graphite supply, exporting mainly concentrate, but it faces infrastructure and logistics constraints. Its strategic value is diversification, a non-China source that could grow and move into more downstream processing over time if project finance and execute well. Molo, that we see here, is an open pit graphite mine producing flake concentrate via crushing and flotation. It is trucked to port for export. It's strategically important as a non-China source while Madagascar has seen political and security unrest. Next source, the operator, has reported uninterrupted operations and shipment. Next graphite supplies is likely to come from Vidalia in the USA, Molo expansion in Madagascar, and Sivio in Australia. And if we look at the overall risks presented by graphite, I would say it comes from graphite processing, which is highly concentrated, that the graphite purification is energy and chemically intensive, and that graphite demand is tightly linked to battery growth in the future.
Now we leave battery critical minerals and visit aluminum, which serves to reduce weight of vehicles and infrastructure, minimizing power required for movement and logistics. While aluminum lightweights what it's incorporated into, it is a heavyweight in terms of production footprint, starting with bauxite production and alumina production, where it's 4 to 2 to 1 tons in final output of aluminum, and all very energy intensive. In the headlines, aluminum's criticality shows up in increasing risk for bauxite global supply chains and aluminum flows in geopolitics and trade tensions. Specifically, Guinea bauxite exports are hitting records on China's demand, further tightening China's grip on supply, while license revocations and resource nationalism in Guinea reshape the feedstock landscape. On the trade side, aluminum prices surge as the US reinstates tariffs on Canadian imports and the EU carbon border adjustment mechanism begins to reshape trade flows based on emissions intensity. Meanwhile, automakers are accelerating closed-loop aluminum recycling to cut costs and emissions, though it still represents a small share of supply. So Andy, let's visit the aluminum landscape and the players and places highlighted in the news.
In bauxite, it is clear that bauxite production has climbed from 180 to 300 million tons since 2000, highlighting aluminium's expanding role in vehicles, in power grids and lightweight infrastructure. When we look at production, we see that Guinea and Australia are the upstream bauxite powerhouses and also exporters. That China has the full stack importing and smelting and consumption profile. That the US and Japan are the heavy consumers with a limited upstream footprint, and that Canada and Russia are the major smelters relative to their own domestic consumption. Our tour today visits Bouquet in Guinea in West Africa, Weipa in Australia, Baotao in China, and then we go to North America to see Alouette in Canada. Guinea holds the world's largest bauxite reserves underpinning long-term aluminium supply. Output has grown rapidly, driven by Chinese, Russian and Middle Eastern-backed investment. Bauxite is mined inland and exported by rail to ports such as Kamsar and Dapilon that we see below us, with most exports going to China and limited domestic alumina refinery. Political stability, infrastructure capacity and ESG expectations shape future country expansion. And Bouquet is the engine of Guinea's bauxite boom and one of the world's biggest export hubs. And the major operators include SMB Winning and CBG, and they mine the plateaus around Sangaredi and export via Kamsar and Dapilon. Australia is the world's largest seaborne bauxite supplier, shaping global alumina and aluminium supply chains. Production is concentrated in Queensland and Western Australia, supported by stable policy, established infrastructure and integrated mine and refinery systems. Much output feeds domestic alumina refineries with significant exports to Asian markets. Competitiveness comes from scale and reliable logistics. Constraints include land access and indigenous agreements, environmental approvals, biodiversity stewardship and water management, with downstream energy costs affecting alumina and aluminium economics. Below us we see Weipa, which is one of the world's largest bauxite production complexes operated by Rio Tinto. We can see the multiple shallow pits which are mined sequentially with active rehabilitation. And the bauxite supplies Queensland refineries and export demand, and shipping uses the port of Weipa via barges and bulk carriers with seasonal limits which are managed. China produces about 60% of global primary aluminium, with huge smelting clusters in Inner Mongolia, in Xinjiang, in Shandong and Yunnan. Power has been coal heavy, though some regions are shifting to cleaner power. China leads alumina refining but relies heavily on imported bauxite, especially from Guinea that we saw a moment ago, shaping trade flows. Baotao is a major multi-potline aluminium smelting cluster, not a single furnace. The long hauls are potlines producing primary metal at scale. Extensive utilities and gas treatment reflect modern smelter design and emissions control. As Mary mentioned in the headlines, Canada is facing US tariff pressure on aluminium trade. Canada's aluminium is amongst the world's lowest carbon, powered by hydroelectricity. The smelters are concentrated in Quebec and British Columbia. The industry is export-oriented, supplying North American and global markets with clean metal. Major owners include Rio Tinto and Alcoa, and the key constraints include power availability, grid contracts, labor and competitiveness versus subsidized coal-based metal. Alouette is a flagship Quebec smelter with multiple potlines. Its competitiveness rests on that abundant hydroelectric power, giving a very low greenhouse gas intensity per ton. And the site illustrates Canada's strategic niche: scalable, low-carbon aluminium for vehicles, packaging and construction, but also for grid infrastructure, supporting North American supply reliability. Next, bauxite supplies are likely to come from Norman Creek and Kangwenan in Australia, Minemartap in Cameroon, Alteo in Guinea, and Metlen expansion in Greece. And looking back, I would say bauxite and aluminium presents three constraints and risks to the energy transition. Smelting is extremely power intensive. Supply chain: bauxite, mining, alumina, refining and smelting occur in different regions, increasing logistics and geopolitical risk. And cost competitiveness, because alumina and aluminium is highly sensitive to electricity costs and grid reliability, with export controls, carbon border measures and industrial subsidies distorting global aluminium flows.
Our final critical mineral stop is uranium, the essential fuel for nuclear power, delivering low-carbon baseload where demand is rising sharply, and control of uranium is increasingly seen as a critical resource for energy security, climate goals, and the next wave of industrial growth. In the headlines, the uranium narrative shifts to powering AI and data centers and grid reliability, shaping a new wave of demand interest. Momentum is reinforced by Cameco and Brookfield partnering with the US government to accelerate an $80 billion nuclear build. Yet even with this demand backdrop, through more uranium capacity, Gazprom is weighing slower expansion beyond 2026, given uncertainty in long-term requirements. Addressing conversion enrichment choke points are security targets, with the US fuel cycle push aiming to expand higher assay LEU plus enrichment capacity to counter Russian control, while Kazakhstan moves towards producing its own nuclear fuel, reflecting broader diversification across the midstream. So let's visit the Iranian landscape in terms of key players and facilities behind these headlines.
Uranium output has grown more modestly from roughly 65 to 89,000 tons, constrained by reactor construction cycles and long nuclear investment timelines. We see the upstream exporters of Australia, Kazakhstan, Canada, Russia, Namibia, Niger, and Uzbekistan. We see that the fuel cycle choke point is in Russia, and which remains outsized in terms of conversion and enrichment capacity. And we see that the big consumers and importers are China and the US, plus France and Japan, both with strong fuel cycle capabilities. So on our tour today, we will visit Inkai in Kazakhstan, the Ural Electrochemical Combine in Russia, MacArthur River in Canada, Olympic Dam in Australia, and Husab in Namibia. Kazakhstan is the world's largest uranium producer, supplying 40% of global mine output. Production is dominated by in situ recovery, making Kazakhstan among the lowest cost suppliers. State producer Kazatomprom coordinates output and paces expansion to manage market balance. And uranium is exported for conversion, enrichment and fuel fabrication abroad. The key Kazakhstan risks sit beyond mining: geopolitics, logistics corridors and fuel cycle bottlenecks. Inkai below us is operated by Kazatomprom Chemical joint venture. It uses in situ recovery dissolving uranium underground and processing on-site into yellow cake. And despite very low grades of less than 0.1% uranium oxide, scale and in-situ recovery deliver strong competitiveness. Output is exported for conversion and enrichment, with expansion being paced. Russia is the global leader in uranium fuel services, especially enrichment. It operates multiple enrichment plants, giving it one of the world's largest enrichment capacities. And this fuel cycle capability supports domestic reactors and extensive export contracts. Enrichment is inherently dual use, so safeguards and international oversight matters. Geopolitics and sanctions increasingly shape access to Russian fuel services and the willingness of utilities to depend on them. The Ural Electrochemical Combine in Novouralsk is Russia's largest uranium enrichment facility and among the largest enrichment sites globally. It's operated by Rosatom. It uses gas centrifuges in multiple large enrichment halls with cascades at industrial scale. And UECC supplies low enrichment uranium for civilian fuel under safeguards, and this is fuel cycle infrastructure, not mining at all. Canada is a leading uranium producer anchored by ultra-high-grade deposits in Saskatchewan's Athabasca Basin. Canadian output is prized for grade, for reliability and strong regulatory oversight. Canada has no uranium enrichment. Conversion and enrichment occur abroad. Production is export-oriented, supplying utilities across Europe, Asia, and North America. And key risks include project timing, labor, and dependence on fuel cycle services outside the country. Below us, we see McArthur River in Saskatchewan. It is the world's largest high-grade uranium mine in northern Saskatchewan, jointly owned by Cameco and Urano Canada. It is mined entirely underground using freeze-wall technology to stabilize water-saturated ground. Production was suspended in 2018 and restarted in 2022. And now, with a capacity of about 6,900 tons of uranium oxide per year, it supports global nuclear fuel supply. Australia holds the world's largest uranium reserves, though annual production is relatively modest. Uranium mining is tightly regulated. Australia exports uranium oxide, not enriched fuel. The country has no conversion or enrichment, relying on overseas fuel cycle services. So exports support global nuclear power, especially in Asia and Europe, and uranium adds to Australia's profile as a major energy exporter alongside coal and LNG. Below us we see Olympic Dam, the world's largest known single uranium deposit and also a major copper resource. Mining is predominantly underground, about 350 meters below the surface, and produces copper with uranium and gold and silver as co-products. It's owned and operated by BHP. Namibia is a major African uranium producer anchored in the Erongo uranium province. Production is typically open pit, low grade and large scale, supplying global nuclear fuel markets. Exports are uranium oxide only, with conversion and enrichment done abroad. Operations are capital, water and energy intensive in a very arid, environmentally sensitive region. Asian demand, especially from China, supports long-term offtake and investment. Husab is a giant open-pit uranium mine in the Erongo deserts, owned by China General Nuclear Power Group via Swakop Uranium, with a Namibian state minority stake. The granite-hosted low-grade ore is mined across multiple pits and processed on-site by acid leaching, requiring substantial water and energy, and that uranium oxide is then trucked to Walfish Bay for export, largely to Asian markets. Next uranium supplies are likely to come from Rook in Canada, Daza in Niger, Tumas and Itango in Namibia, and the Budinovskoye and Severnoye fields in Kazakhstan. Looking at the risks that uranium poses to the energy transition, the supply chain of mining and fuel service is concentrated, creating risks along with conversion, enrichment, and fuel fabrication capacity constraints. Permitting for mining and nuclear projects face long approvals, and the cost of transport, enrichment, and waste management require stringent oversights, raising costs.
In concluding our tour, let's sum up on the landscape now and on the horizon along three main fronts: diversification, dollars or prices and investment, and coverage and alternatives. Today, we see geopolitical focus, where securing critical minerals is now a national security and energy independence issue, not just an economic one, with strategic diversification sought by the US, G7 and allies, Canada, Australia, Japan, etc., and who are starting to invest in non-Chinese sources, forming partnerships and building processing capacity outside China. On the dollars, prices and investments front, an investment boom is brewing, with haste to invest in frontier markets, such as the US and Argentina, and on new processing tech, with policies further driving the market, such as US-China export controls and agreements and domestic initiatives, Canada's strategy, starting to shape investment and supply amid price volatility. On coverage and alternatives, the focus is starting to shift to new sustainable processing methods beyond traditional smelting to break China's refining hold, with attention expanding to a fuller set of vulnerable minerals and downstream. Specifically with recycling, there is a recycling gap where a significant opportunity and challenge exists, as current global recycling is very low and much ends up in the landfills. In our horizon, by 2035, we can expect progress in diversification outcomes, but with ongoing refining choke point as lead times keep the West partially dependent. On dollars and investments, while policy supports investment, lead times and other constraints will contribute to ongoing tightness and volatility in prices. Thus, China's midstream dominance endures, with only modest dilution by 2035 and concentration across minerals such as graphite, cobalt, and lithium remaining. In various outlets, including the IEA's 2025 one, lithium faces a 40% primary supply deficit by 2035 and copper 30%, even if announced projects proceed, highlighting capital, permitting, grade, and discovery constraints. This is because mine development timeframes are structurally long. Average lead time from discovery to production has stretched to 18 years for projects starting up in 2020 to 2023, meaning many announced 2025-26 projects won't materially de-risk supply by 2035. Finally, recycling rises but remains a minority share, staying well below 10% by 2035, absent systematic collection and design changes to bring it up from 1% today. Bottom line, for 2035, expect partial decoupling from China in mining and some processing, but not full independence. Tightness and volatility persists, even with regional strategies such as the US, EU, and Canada, Australia, and Japan improving resilience, but still exposed at the refining choke point layers and constrained by long project cycles. Of course, all positions depend on the geopolitics of China and G7 countermoves, real progress on reversing constraints, and the pace of innovation. So thank you for your interest in the critical subject of critical minerals. We look forward to progress that reduces critical availabilities to support electrification and our energy future. And as a final comment, as a Canadian, I hope to see Canada make haste to position itself as a player in this space, seizing on its potential beyond uranium.